this is going to be a little more of the dry content, just making sure everyone fully understands everything in scope, everything talked about, pretending like everyone in attendance has no idea what's going on and they need to catch up. So, I mean, in my opinion, this was some of the biggest news for anyone in crypto accounting in 2023, the ASU 2023-08, because there was a problem in the accounting for digital assets. It was a new concept. Data was unique. There was blockchains, there's exchanges, their technology was limited. They labeled digital assets as an intangible asset, so reporting a cost while doing impairment. It wasn't as easy as it sounded, though. Impairment for digital assets wasn't the same as other intangible assets, but it was treated the same. But the problem, the data quality, the available data from like a pricing perspective, the inventory management, that was all unique and new. And how regulatory bodies viewed the different requirements was very different, specifically on impairment. Yeah, how should you do the impairment? Should it be done at a 1 minute VWAP, a 5 minute VWAP, end of day price? Whoever you talk to seemed to be a different opinion. So, you know, from Cryptio's perspective, we were also trying to figure out and customize solutions because there was not one single solution for that. But now we're in 2024, and the FASB has made the groundbreaking fair value announcement towards the end of 2023. And now we are in 2024 where we could early adopt. And it looked like in 2023, the FASB really pushed this through very fast, faster than they have most things. I think they saw the urgency needed within the marketplace. So why did they announce the ASU 2023 and why is it important? Well, it's important because impairment's no longer needed. I think it was a complete headache for tons of different companies. Also, companies, mainstream companies that are crypto curious, ones that wanted crypto on their balance sheet, they probably stayed on the sidelines. They didn't want to hold their digital assets at impaired value because it goes against the economics of their company, and they didn't want to report gains or losses from the impaired values. So all these things coming into effect also stopped mainstream adoption, in my opinion, and now that we're at fair value reporting, it provides a lot of transparency into a company's true economics. Companies and investors can make more calculated decisions. In most cases, companies were also double reporting, reporting at cost, which they needed to do, and also reporting at fair value because their board and investor needed to understand the company from this aspect. So there was a lot of double work going in. Even if companies didn't need to report at fair value, they were likely getting at least some viewpoint into where does their company stand. So getting into the topics here, making sure everyone's well aware of everything that was talked about in the FASB meetings. The obvious one, fair value, is in accordance with topic 820, fair value measurement. That is making sure that during your reporting period, at a minimum, you're valuing your assets to the most recent price that they should be recognized at. Assets in scope. Now, not all assets were included. The FASB wanted a narrow scope to ensure they could make these changes and push them through in a timely manner. If it was too wide, it would have taken too long. So they narrowed the scope. We'll go into this more on slide 2. Financial presentation. So at a minimum, they're requiring that you present the aggregated amount of crypto assets separately from other intangible assets that are measured using your measurement basis. That's also presenting gains and losses on crypto on a separate line item for income. And also that crypto assets received as non-cash considerations during the ordinary course of business that are converted almost nearly or immediately to cash as operating cash flows. Onto the disclosures. This is also one of my more favorite because I think disclosures add transparency. Transparency adds trust into what is going on in your financials. So the more details in disclosures, especially if they're required, the better. And also more consistency between companies, how you can compare them now. 3 major disclosures that are required: significant crypto asset holdings. This would be including the name, cost basis, fair value, and numbers of each unit, the aggregate values and cost basis of other crypto holdings, and reporting this both at annual and interim periods. The next one's restricted for sale. They've seen that a lot of companies had balance sheets that were just completely illiquid. They couldn't sell assets if they wanted to. So making sure that you highlight assets that are restricted from sale, and the fair value of those crypto assets and the nature and remaining duration of the restriction and the circumstances that could cause the restrictions to be delayed. And this is also required both at interim and annual periods. And the last is my favorite, the asset roll forward. I think this gives a lot of great transparency into what's going on within the company. This is only required at an annual period. I personally think companies should be doing this as a control monthly, at a minimum quarterly, but it's only required annually. That would be showing any additions with the description and activities that resulted in the additions, dispositions, gains, and losses within the asset roll forward. For the disposals, the difference between the disposal price and the cost basis, and the description of activities that resulted in the disposition. Now, if gains or losses are not presented separately, the income statement line item in which those gains and losses are recognized. So you need to at least show that somewhere.
Jeff,
And the message, yep, go on.
I was going to say a quick point there. Depending on also just sort of the format you have your asset roll forward in, it could also double as a significant holdings report that you mentioned in that first point. So that's just something to throw out there for people who think, oh, maybe they have to develop a new report to kind of satisfy that first requirement. That if you, as long as you have some of the points Jeff mentioned, like the name, the value, like things like this, if that's already baked into your asset roll forward, then it sort of covers off both.
That's a good point, Jermaine. And the last piece is just including the method for determining cost basis for the crypto assets. Are you using LIFO, FIFO, WACC, etc.? So let's understand how you got to the gains and losses. The next piece is the transition. This is the other big one. A lot of companies are likely still reporting at cost. They're trying to decide when is a good time. It's never a good time, usually. It's always busy, and you could always delay this. But, in my opinion, just ripping the Band-Aid off and getting to fair value is probably the best approach. And what you need to do is make a cumulative effect adjustment to the opening balance of retained earnings or other appropriate components of equity or net assets in the statement of financial position as of the beginning of the annual period. So what you need to do is you need to value all the impaired assets up to cost to the beginning of the fiscal year, and then the actual fair value adjustment will happen at the beginning of the annual period. So this is effective for fiscal years beginning after December 15th, 2024, including interim periods within those fiscal years. And that's for all entities. And early adoption is permitted. So companies could start putting this into effect now. The only requirement in early adoption is that you cannot report your financials in any fiscal year. So I've talked to some companies that haven't reported their financials for 3 years. So they're talking about doing their 2021 fair valuation. So you could go back as far as you haven't done your financial reporting. And this will be also effective for fiscal years beginning after December 15th, 2024. I think I've already mentioned that. And the last piece here is just documentation. This is it's a big change. Try to document and prepare policies and procedures around everything you're completing, so it's clear to your internal team and external teams, what you've done. I think it's important to always document the different processes and procedures that you've done. Some other highlights here, key considerations. I've highlighted that early adoption is allowed on any fiscal year financials have not been reported. Some more details here. The FASB had their meeting and had their votes on September 6th. I think the previous meeting was earlier in the year, maybe like 6 months prior to that. So they did move fast. And then they decided December 14th that the earliest interim period for adoption. Now, within the scope, this is directly from the FASB, and we'll talk more about a few of them. A few of them are very straightforward. A few of them are not. It meets the definition of an intangible asset. That's the majority of crypto assets. Not represented as a contract or provides enforceable rights. So this one we'll get into more details because this could include wrap tokens. This could include some interpretations that are needed. Needs to reside on a distributed ledger based on blockchain or similar technologies. I think a lot of these things, they just had to make sure they were crystal clear in what was in scope. Secured through cryptography, fungible, so no NFTs, and not created or issued by reporting entities or its related parties. And we'll get into that one too on the second page. So there are definitely some gray areas that we've identified, and this is both through Tremaine and I's conversation with multiple clients, with multiple accounting firms. The first one is what does not represent a contract or provide enforceable rights to an asset. Prior to the last meeting and their final notes or meeting minutes, they used to have the terminology of wrap tokens. Now we've had many conversations around wrap tokens are not included, but the conversations are kind of spinning towards a way where you could value wrap tokens. Now I've had conversations where companies are considering treating wrap tokens as a receivable or as an embedded derivative, so they could show these tokens as fair value on their balance sheet. Tremaine, I believe you've had some other conversations around this as well.
Yeah, definitely. On my side, some people have taken sort of the more not extreme, but the more different interpretation that like wrap tokens, for example, which everybody sort of assumed this was meant for, doesn't necessarily represent a contract. It's its own standalone token that, yes, can be swapped for another token, but because the asset on its own has like its own public market value that you can see. So whether it's wrapped ETH, you could go to your CoinGecko, your Coinbases, and you can see a clear valuation for this, which is different than if you went to ETH itself. Because of this mechanic, they're saying that this isn't necessarily applicable to wrap tokens, and then therefore wrap tokens would be in scope as one of the things that you can fair value. So it's I think we're going to definitely see a lot of shakeout over the next year or two to kind of develop best practices, because as you said, all these different interpretations are starting to come out because more and more people want more things in scope than less. So it's just this game of, how much can we get away with in terms of the language that they give us.
Yeah, I think that's fair. And I caught up with the FASB, and this was deliberate. I think they want a lot of companies and their accounting firms to make these decisions on their own. So, wrap tokens, on paper, it kind of fits this category, but like Tremaine said, there are reasons around it. And as long as you document your arguments for valuing wrap tokens, which you do not see as something that provides an asset holder with the right to another crypto asset, then you have the right to fair value them. The next piece is expenses. It was not talked about in the FASB meeting, or you know what, it was talked about, but in the end they decided not to comment on it. And that's between should you capitalize or expenses incurred. They were leaning towards expensing as incurred as a requirement, but I don't think they wanted to put their foot down on this one, as the data quality still is not where it needs to be, fully breaking out these expenses, where there are expenses sometimes baked into trade prices. So they kept this one as is. I would say it's our recommendation to expense as incurred. It really provides a lot more transparency into what's going on within the business. You could capitalize, but I think as best practice, and this is just our opinion, that expense as incurred is definitely the approach best taken.
Yeah, and I would say for that one too, Jeff, a lot of the reason why we've seen people sort of gravitate more towards this sort of expense versus capitalization is really just presentation, right? Like Jeff said, the transparency of having clear line items on your trial balance and your balance sheet, your income statements that say, this is how much I incurred in this year for this particular expense. It's much more digestible for any reader, whether it's internal, external audit, boards, things like this, versus with capitalization, what we've seen is there's a lot more work that goes into sort of figuring out, okay, why is this asset valued at X? Well, it's because there's a cost baked in on top of the actual market value, and then digging through what is the support and documentation for all of that. Like as Jeff mentioned, it's the FASB's given sort of the flexibility to do both, but we've sort of seen it develop as more and more people gravitating towards expensing over capitalization.
And then the next piece is pricing. They didn't comment on any specific pricing. I think that's because of just the wide variety of pricing ability, of pricing venues and sources of getting your pricing from. I think there's definitely best practice in pricing, and that would be picking your principal markets. We'll get into that in a couple other slides, but it's just to highlight that the FASB didn't make any stance on pricing. Some companies that are doing it out of spreadsheets, it could be a little bit more challenging, and I think they understand that. If you use a company like Cryptio, it automates it and makes it a little more simple, but not everyone has the budget to onboard a SaaS product that has in-depth pricing capabilities. So they kept that one a little in the gray area, we'll say. The last area that was a little bit more of a gray area is, minting internal tokens and related parties. How do you treat these? How should you treat these tokens if they're transferred from one foundation to a lab or vice versa? And I think one of the main points here is that you need to maintain internal tokens at cost, which is zero for most of these companies. And even if you transfer it to a legal entity, or let's say it's even unrelated, a lot of ways these labs and foundations run, you should still think in tracking these at cost or zero instead of valuing on them. Let's call it a stablecoin to $1. Jermaine, do you have any additional insight for this point?
Yeah, I would say, especially on that last piece that you touched on in terms of unrelated parties, a lot of it, if it's related, I think the language is very clear that you should still maintain that zero cost basis. You can't fair value these up. But I think in the context where if you're purchasing as an unrelated party a minted token from somebody else, then in the context of your own balance sheet and in terms of your own reporting, you could be able to find fair value these, because again, if you purchase these on the public market with no relation to the actual minting entity itself, these are now not considered like self-issued or self-issued from a related party perspective. So that's just one other caveat to touch on that part, John.
Thanks, Jermaine.
Documentation, Jeff, you wanna kick this one off and can jump back and forth, or you want me to?
Yeah, I mean, I think this just highlights when you're going from your old to new process, make sure you're documenting everything. Make sure you're updating your processes and procedures, your different controls, and all the different things that you're doing in a new way. I think a lot of times this comes second, or it comes right before an audit as the oh no moment, when you need to have all this necessary stuff, but it's something that's always delayed or kicked down the street, where you say I'll do it another day. It's just like get it done with and update all your documentation, update your risk control framework, make sure that all this stuff is up to date on a frequent basis. And Tremaine, I think you've highlighted, you've worked with a lot of clients that have already either been reporting at fair value or have done the transition. Do you have any interesting stories to tell there?
Yeah, I would say it's you would think on paper, because we're doing such a big switch in terms of the valuation, that the process would be very different, but ultimately it's really just swapping out that process of impairment for the process of fair value adjusting. So whereas before everyone was testing to see if prices went lower, they're basically doing that same exact testing at the end of their usual month-end close. So after you take a look at inflows, outflows, you're looking at your ending balances. Once you get to that ending balance section, it's really just a swap out of, am I checking for if my prices went lower, to am I just checking for any price fluctuation at all, and then applying that revaluation. So I think, thankfully, depending on how you already currently have your internal reporting structured, it might not be so much of a change. I think a lot of it will just be in terms of you creating a lot of these new chart of accounts to capture the revaluations that might not have existed before when you were doing impairment.
And how have we seen companies treating fair valuation as opposed to cost? I know when running costs, usually your balance sheet doesn't change too significantly. Where running a monthly type of reporting for a lot of the companies we support was accepted. Do we see a lot more people running this more frequently, where they're running fair value on a weekly or even daily basis just to see market moves? Let's say Bitcoin moves up or the market moves up 10% in general. Like, are we seeing more focus on frequent reporting?
Yeah, I would say it's for investment entities. So think like a portfolio company, your banks, like these type of entities. They're the ones that we see sort of employ this more frequent revaluation, like you touched on. So like in their case, they're looking at it daily, the daily fluctuations of pricing, versus for other entities, big and small, if they don't have that sort of like investment title attached to themselves or a subsidiary, they've sort of kept their own revaluation process. As if they typically do a month-end close, they do it once a month. If they do a quarter-end close, they do it quarterly. Our recommendation, like you touched on earlier, is do this once a month. It just makes the process easier because you sort of get into this flow. But yeah, I've seen companies so far go both ways of, we're just sticking to whatever our reporting periods are. And if it's quarterly, we'll do it once a quarter. If it's monthly, we'll do it once a month. But exception
Gotcha.
again is investment companies.
Mhm. So let's talk a little bit about pricing and why it's important. I think there's a lot of ambiguity in pricing, where you could get your pricing assets from, transparency into the pricing. It could be complex. There could be fragmentation, high volatility, where the accuracy of the pricing could come into question. If there's like a spike in a candle and that's the price you grab as of month end, where there's a 5% variance to maybe other pricing sources. Exchange rate discrepancies, like I just mentioned, across the different exchange rates. So how do you actually do your pricing? It must be auditable. You must, an auditor must be able to come in and verify the prices. They have to make sure that it's robust pricing. They could replicate it. That the exchanges or pricing source that you use is transparent and also reliable. But a lot of these things are easier said than done. What does that mean? I mean, what we would recommend is the principal market for your business. So that's where you're most actively trading or transacting crypto assets, whether it be on a Uniswap or a Coinbase, and also the highest volumes. So even if your exchange isn't the most active volume, you might not want to use that exchange. You want to use the exchange that represents the prices that most people are getting, where the most volumes are being had. And then make sure it's just GAAP and IFRS compliant. I mean, there's a lot of different requirements to go into this. You might need to price different assets instead of a blanket pricing across the board. And using Coinbase, maybe you'll need to split it up between Coinbase and Binance International, where you get better prices from Binance for specific tokens.
That's a really good point,
Next
Joe. I
page,
mean,
please.
especially with what we've seen where Coinbase, even if they're more granular, the scope of assets they cover compared to like a CoinGecko is like, what is it, like 1,000 versus 20,000 or something like this, some crazy
Right.
difference.
right? And CoinGecko, you could use it. It's just less. It's less desired because it's not a principal market. CoinGecko is considered a global volume weighted average price. So it's taking all the exchanges globally and weighting them based on the activity within each exchange. So replicating those prices for an auditor is very difficult. Where, I mean, a lot of times they don't get many discrepancies, albeit, but auditors love seeing one single source of truth when it comes to pricing. So that's just picking your principal market. Now, when talking about very liquid pairs or liquid assets, this is where Cryptio uses a pricing provider called Kaiko, and they have unique cross-price referencing for getting to a liquid asset prices. So they have complex calculations behind the scenes to make sure that if there are very liquid assets, they're going to try in a triangular formation of calculations to get to a price which they could verify as accurate. So even when that's when a lot of the discussions come up. It's around these illiquid assets. How do you price them? What if there's a price, on the 15th of the month, but there's no trading volumes since then, and you can't price it? How do you get to a price? A company like Kaiko is helping solve that issue through unique pricing algorithms. And, these are all things that they're running by accounting firms. Companies like Bloomberg are using them. So it's also going with a trusted pricing provider when you're talking about picking principal markets or getting your pricing. Other considerations to talk about. You want an orderly. Go back one, please, Jermaine.
Yeah, that's all right.
You want to apply a market-based orderly transaction approach. Rely on quoted and observable prices. A lot of these things are very obvious, but at times you need to just state it. Identify the principal market, as I mentioned before, is the greatest volume and level of activity. Prioritizing the same execution exchange and direct U.S. market as per the assessment for the IRS. And then accept that there's no prescribed exit price for a market or a closing price. Therefore, any reasonable approach based on volume, liquidity, or activity is valid as long as they're well documented and justified. But not just that, there's a lot of other considerations that companies are going through that we've worked through, that we've talked about. Jermaine, you want to share a little bit of what other companies are also considering when they're picking a principal market?
Yeah, definitely. I think especially when we talk about these more regulated entities like the banks and people that are under just more scrutiny in general, they tend to consider what are all the AML and KYC requirements within the principal markets themselves. So, what type of customers are you servicing? What type of jurisdictions are you servicing? Are you allowing people from, let's say, countries that are on the OFAC sanction list, think your Irans, your North Koreas, countries like this, because for them, they want to sort of stay away from any sort of compliance issue that they could run into as a result of relying on information from entities that are servicing anyone that could raise a red flag, whether it's with their auditors, with the SEC, like whoever it is that sort of is going to be looking at them with a magnifying glass. And I think as we've seen with crypto, it's just under a lot more scrutiny than other industries at the moment. So we've just seen people really take this more cautious approach of, if we're going to pick a principal market, we want them to almost meet our own standards of, compliance and things like this.
That's right.
Well, so I think just to kind of wrap up a lot of what Jeff said earlier, for us internally at Cryptio, we've built a fair market value module, and a lot of the features that we've built for the module is around a lot of the best practices that Jeff touched on earlier. So this will first off, it's the ability to sort of capture different cadences in terms of how often people want to revalue their assets. So, whether you're a bank that needs to do this daily, whether you're just an enterprise company that wants to do this monthly or quarterly or even annually, if you just want to meet the bare minimum requirement. I think for us, it was really important to give that flexibility to all of our customers. This also ties into for every single reevaluation that we do, giving both at the report level, but also within the product itself. And a lot of this I'm going to touch on in a bit during the product demo, but just a way that you can clearly reconcile all adjustments at the unit level. So we show you everything from the volumes that we apply the adjustment on, what was the price of the volume prior to the adjustment, what was the price tested against, and then sort of what is the new ending balance for all of these lots as of these revaluation days. We found that this is super, super important, especially for companies going through audits, to not have to go back and redo work. If you can just hand over a report to them that sort of captures all of this, it just makes your life and the auditor's life easier. Additionally, just good ways, seamless ways, easy ways for you to map all of the adjustments into chart of accounts, into your general ledger that you can push to your ERP or even just use within Cryptio in our own trial balance. That was super important as well. Asset pricing, Jeff did a really good job just now of just breaking down principal markets, but within Cryptio, everything that he basically mentioned is how our own principal market selector works, right? So it's built around flexibility for people that want to use, let's say, Coinbase for one asset, but maybe CoinGecko for another asset, or the ability to switch very easily. That's something that we found is really, really important. And I'm going to be touching on this in the demo as well as compliance and cost basis management. This sort of ties back to the report I mentioned earlier, but making sure that for every revaluation done, we can provide a clear, transparent audit report that you can look at, that you can use for any internal compliance reporting, as well as external. Okay, give me a second. I'm gonna switch over to Cryptio. So, Jeff, you can see my screen?
Yep.
Awesome. So for everyone that hasn't seen this before, this is Cryptio. As we mentioned earlier, we are an accounting, audit, tax product that basically allows crypto native companies and also non-crypto native companies, anyone that does any crypto reporting, to sort of seamlessly transition this into financial reports, accounting reports, everything, top to bottom. For today, we're going to focus primarily on the fair market value module. One of the things I want to show before we jump into that is around a lot of the pricing and principal market stuff that Jeff touched on earlier. So the way how we've the approach that we've taken for being able to revalue a lot of your assets is, we found that at first we provided a one selector for all assets. And this was sort of how the initial build was, where you could go in and you could select from your Coinbases, your CoinGeckos, your Binances, and this would apply to every asset in your workspace. Over the years, I think, as Jeff mentioned, we've seen best practice shake out much more around needing more granularity in having some assets potentially priced at one market and other assets priced at another. And a lot of this has come around realizing that for the more material assets that are available, let's say on a Coinbase, auditors prefer you to use Coinbase there because they want to see this singular pricing method approach and not this aggregated VWAP approach that Jeff mentioned, like that what Coinbase, CoinGecko uses. But in the event that you have less liquid pairs that aren't available on Coinbase, they still want you to price these. And that's where we give you the flexibility in being able to select different principal markets. So for example, you can see here in our principal market selection, we list out all the assets in your workspace, and we list out what are all the current providers that these are using. So you can see here, legacy, daily, CoinGecko. This just means for CoinGecko, they have two different pricing approaches. They can either give it to you daily or hourly. Daily is what this demo workspace has right now. And what you can do here is you can select as many as you need. You can edit and change to any other market that we provide. So here in this case, you can say, if for these three assets, I wanted these to all be Coinbase instead of the CoinGecko Daily. It's as easy as you switch, you can hit apply to all. Maybe it's the case that you want to mix this up a little bit. You want to say Kraken for one, Coinbase for one, Binance for another. You can also select the period, because in some cases we've seen auditors also say that they don't want you to retroactively go back and reprice things. They want to take sort of like a forward-looking approach. So here's where you can actually select as well, what's the start date of when you want these new pricing methods to kick in. Super important. And again, the goal here is giving you as much flexibility as possible when you're going through your audits. That way, in the event that they throw you a curveball or they say, hey, we want you to change something, we want this to be easy for you, because any selection you make here flows through as well into the fair market value module that we're going to touch on in a little bit. So this is super, super important.
I think another thing to note too, on what Cryptio is doing, you saw about 5 different principal markets. We have the ability to give more. It's just not to overwhelm the client. A lot of times we'll focus the principal market towards the region they're operating out of. But we have the flexibility to give most principal markets that have actively traded assets.
That's a really good point, Jeff. And the last bit actually on the principal market is, for every selection that you make here, we also give you the option to just to generate an audit report for your principal market. And again, the goal here is, once you're sort of done with pricing all of this, we don't want you to have a long conversation with your auditor. We want you to be able to just hand them supporting documentation and they can go away and sort of do their part. So here, once you generate this audit report, it's going to give you a list of every asset you have in your workspace, every principal market assigned to each, the period. And this is something that you can just save internally as part of your policy documents, or you can just hand this over to an auditor if need be. Cool. So now I'm going to jump into fair market value module. Where I want to start here is first our scheduler. And actually, before the scheduler, let's just take a look at the ability to just create an adjustment in general. So in the module, you can see at the top, you have a couple options. You have schedule fair market value adjustments. You have plus adjustment. For plus adjustment, this is if you wanted to one-off ad hoc adjustments that for your workspace for all of your assets. So this is especially important when you're thinking about that first transition period from cost and impairment into the fair value reporting structure. Here you can select, okay, as of the first of my reporting period. So let's say you wanted to transition in 2024, you'd say, okay, on January 1, I want to run my first adjustment. And this is going to sort of give you that number to compare to your prior cost basis. And as Jeff mentioned, in that transition period, there's 2 adjustments that you basically need to make. You need to catch up your assets first from their impaired cost basis to their original cost basis, but then you also need to catch up from that original cost basis to their new fair value adjusted cost basis. This here is super important, and this will give you the option to, whatever the start of your fiscal year is, this would be your sort of go-to in terms of capturing that initial adjustment period.
And another point here with the
sorry.
with adding an adjustment, I mean, anytime markets go up, call it 20% in 4 days, and the CFO says, how did that impact our bottom line? What are the economics of our company? It gives you the ability to just quickly run fair value on any point in time, quickly through reports with lot level details.
It's a really good point, Joe. And then on our scheduler, you can see here, as we mentioned, we try to give it as much granularity as possible, everything from daily all the way up to annually. Daily is pretty straightforward. We would just run an automated fair market value adjustment every single day, which will flow into your reports. Weekly is the same thing. You could select a particular day of the week that you'd like to run an adjustment on. And again, every period that you see, I sort of touch on here, this is going to flow through automatically into all of your reports. So if you run a adjustment today and an adjustment, tomorrow or next week, when you run your reports at the end of the period, this is going to capture every single adjustment made and give you sort of that cumulative effect. So that's just something that you don't have to worry about when thinking about, I've seen conversations around people saying, I don't want to do it too frequent because then that's more work for me. This is just to kind of highlight that this doesn't actually increase your workload at the end of the day. This also extends to monthly. You can select once a month. Is there a particular day of the month that I want to do this? Do I want to do it maybe on the last day of the month? Then you don't need to worry about a date selector. The next thing is quarterly, same thing. And then annually, of course, is just once per year. So this is just to kind of touch on the flexibility that you have in between this and the principal market. What you can imagine is once you've sort of set up principal market for all of your assets, every time your fair market value scheduler runs, it's going to first take a look at what's the principal market assigned to every single asset, pull the price for every single asset on the day in that particular principal market. So if one has Coinbase and another has CoinGecko, it's going to be pulling the prices based on those individual selections. And then we'll be calculating all of your fair market value adjustments, which additionally you can map and push directly to a mark-to-market account on your balance sheet, an unrealized account on your income statement. And that piece for us doesn't change much. In Cryptio, we give you the option to map as many accounts as you need. So in most cases, what we've seen is companies will set up a mark-to-market account on the balance sheet. They won't actually book the adjustment directly to the asset account. And that's just best practice so that when somebody picks up your balance sheet or your trial balance, they can clearly see, okay, the net effect of my Bitcoin today is at 50K, 5K of that is due to adjustments, 45K of that is due to original cost, versus if it's sort of in one account, you'd have to, again, find a way to break this out for an auditor, which we've just seen end up being more work than people expect. I want to jump into the reports a little bit just to show you guys a bit of the detail that we provide. So this report here, this is an example of our lot detail report. And this is the one that I mentioned earlier is like super important because reconciliation behind these adjustments is a key part of the new fair value rules. Being able to reconcile, as Jeff mentioned, within the significant assets, names, volumes, values, periods, balances, all of that stuff, you need to be able to do that. And we've seen this could either be very, very tedious or very, very easy, depending on the kind of data available. In our reports, you can see clearly for every single lot available at a certain date, we give you the asset type, we give you the volume of the asset that was available as of that date when you ran the adjustment, we give you what the original asset rate was, so you can sort of compare, okay, what was my cost basis at the time? And all of this we use to calculate here in column J. And once we get to your beginning balance, we compare that to a market rate. That market rate then tells us, is there any adjustment? What is that adjustment? And then you get a new ending balance at the end of the adjustment period. You can imagine for this, every month, let's say if you do a monthly close, if you have your scheduler running, let's say the last day of the month, all you do in Cryptio, you wouldn't have to worry about, are my adjustments being done? This is being automated. You would just generate your reports. And actually, just to kind of touch on this, in the reporting section, anytime you create an adjustment, it auto gives you these download buttons for a lot level detail report and a ledger entries report. This way, in terms of just your overall workflow, you don't have to think about where do I go. You just immediately grab these. This was going to produce a report just like this. You use this to reconcile at the end of each period, and you save this down as sort of your documentation. So at the end of the year, you can imagine if you do this once per month, you'll have 12 reports that you can easily hand over to an auditor that can support all of the balances in your mark-to-market accounts, your unrealized accounts, and just sort of streamlines that whole process for you, both from a monthly reporting process, but even looking out 12 months into the audit itself. On the asset roll forward side, so like we mentioned earlier, it's really interesting. This all sounds like it's a big switch, but really the only change here is in this column J. Previously, this used to be impairment. Now it's just fair value adjustment. So everything else stays the same. We track all of your sources, all of your wallets, your exchange accounts. We track what assets, we track the amount of units, all of your deposits and withdrawals. The only difference is at the end of this process, instead of checking for impairments, we check for fair value adjustments. And then this is what sort of transitions into your ending balance and your ending units at the end of the period. We had briefly touched on this earlier, but the significant asset report requires a lot of these fields that you see we include here, which is why when you think about your asset roll forward, it's really good to sort of build it in this way where you can double up and knock off both parts of that FASB requirement, as opposed to needing to, have one asset roll forward report, one significant asset report, generating both of them and, sort of keeping up with that workflow. And then the last bit that I want to touch on is just on the ledger entry side. So for here, what we do is every single adjustment that you make, we transition this into a journal entry that you can either push directly to your ERP, you can generate a report and keep it all in Cryptio. But either way, what you can see here is it tracks a mark-to-market account, the unrealized account that matches. It gives you the data of the fair market value adjustment. And one key thing to point out here is that if there's any subsequent disposals, transfers, anything like this for a lot that has an unrealized adjustment assigned to it, Cryptio will automatically reverse all of these and book a realized gain in the context of a true disposal. If it's an internal transfer, it'll reverse any adjustment that belongs to that first source. And when you, let's say, transfer to wallet B, we will revalue these assets as of that point in time. So all of this, you can imagine, is happening in the background. All of this is flowing to your reporting. So really the only thing that you need to focus on at the end of each period is just this: go in, take a look at all of my adjustments for the period, download my lot level report, download my ledger entries report, make sure that I'm comfortable with everything is reconciled, and just saving this down. And really the goal here is just to streamline the process in that way so that you can focus on all the other things that are important to you. How is performance for certain things, things like that.